So welcome everyone. We're very happy to have Mark Kerßenfischer with us today to speak about outages in sovereign bond market. And I believe Mark's co-author Caspar is also here. I was planning to join, so I don't see him on the list of participants, but so we have a chat if you have questions. And other than that, just please, you'll have to raise your hand and we'll have to unmute you if you have any questions. Thank you. And Mark, the floor is all yours.
Perfect. Yeah, thanks. Thanks for having me. First off, if you have any questions, just interrupt at any time. Yeah, I'm presenting joint work with Caspar Helmus, colleague at Bundesbank here, and we are studying outages in sovereign bond markets. So as a motivation, I think you all agree that the risk-free yield curve is pretty important in asset pricing. And we already know a lot about why bond yields change, namely news and flows. And that's not what we are after here. So we want to study the who, how, and where of the price formation process. So how does this risk-free yield curve actually form? So which investor types are relevant? What instruments do they use? And where are they active on what trading venues? And these are usually super hard to study, these questions because they're all interrelated. And we exploit market outages as natural experiments to answer these questions. And these are unanticipated and exogenous shocks. So usually these are technical glitches. You can think of power outages, like natural disasters type of thing. So they are totally unrelated to the trading process. And these are highly informative about how the market functions in normal times. And this is basically the preview of our results. So at a macro level, we study 3 types of outages. And the first one, the most important one, is are outages on the futures market, because these have just dramatic effects. So when the futures market goes down in Europe, basically the cash market stops working. So trading volumes go down, the liquidity on the cash market goes down, like evaporates entirely. And the transaction prices that do occur, those occur at ridiculous prices. So there's a lot of noise, a lot of dispersion of yields around the fair price. And this is what I will spend most of my time on today, because this is the most important type of outage. And then what we also look at, secondly, is outages in the other direction. So what happens when the euro area cash market goes down? And of course, the entire cash market has never been down, because it's we can't study a complete outage of the cash market. So the best we can do is outages on specific venues on the cash market. And here we have 5 outages on 4 different venues. And in each case, what we see is that, yes, these outages have an effect. So there's less trading volume, both on the aggregate cash market and also on the futures market, but the market functions properly. So there's no comparison. So it's a one-way effect, basically. Futures market have dramatic effects on the cash market, and there's barely any effect in the other direction. And we also have a good idea about the micro-level mechanisms behind these effects and behind this asymmetry. And then lastly, the third type of outage is are spillovers. So we look at the futures market in Europe, and look, when that goes down, we look at Chicago, the futures market in Chicago in the US, and vice versa. And there we don't see much. So we find a null effect. And that remains somewhat of a puzzle to us. So we're looking forward to explanations you might have. So we would have expected some effects, especially from the US to Europe, but we don't find any. Okay, so one slide on the European government bond market. I think that's pretty similar in the US also. And the most important thing is that it's very different in the futures and the cash market. So the futures market is entirely centralized. There's only one venue you can trade on, Eurex. And there's only a handful of futures. So Germany has 4 Bund futures, and there's a couple for Italy, Spain, and France. And this is all on Eurex, as I said. They have a central limit order book, and it's super transparent. You can see all the quotes and prices. And also after the fact, the post-trade transparency is good. And we got all the data, so no problem on the futures market. The cash market is a very different beast. It's totally fragmented, first of all. So there's hundreds of bonds, or that's roughly 100 bonds per country at any point in time, very different with different coupons, different maturities, and so on. And these can be traded on very different venues. So these can be traded OTC, but also on electronic platforms like Tradeweb, Bloomberg, also on a dealer-to-dealer, interdealer platform, MTS, on regular exchanges that rarely occurs, but could happen, and also via brokers. And all of these trading venues, they employ different trading protocols. So OTC is typically voice or chat. There's electronic platforms. These are request for quote systems, and MTS is the only one, and these regular exchanges that employ a central limit order book. And the transparency is also just, yeah, pretty awful, I'd say. It's about to improve, hopefully, but yeah, so there's basically no pre-trade transparency. The only actual firm quotes you can observe are on MTS, and these are restricted to dealers. And then after the fact, even there's no consolidated tape. So you don't know at what prices bond traded in the past. And yeah, that's hopefully it's about to improve. And usually what hinders most research is data availability. So this is a pretty unique feature of our data, that we have got great data on the cash market transactions. So we start, thanks to our Bundesbank affiliation, we have access to this MiFIR dataset. And that's basically, in theory at least, covers all transactions in German government bonds. So where either counterparty is German, located, domiciled in Germany, or the trading venue is German. And yeah, we have pretty great data on German bonds. Problem is that yeah, we don't have that good data on other countries. That's why we reached out to any trading platform we can think of, basically, and got transaction level data from them as well. So we augment this non-anonymous transaction level data set with data from trading platforms, so MTS, MTS Bond Vision, Tradeweb, and also from interdealer brokers. And then lastly, we are also interested in the liquidity, not only in the executed transactions. And yeah, the liquidity measures, we got executable quotes and volumes from MTS, and indicative quotes from Bloomberg Refinitiv, and also from one interdealer broker, TPI Cap.
Sorry, can I ask a clarifying question?
Sure.
For the augmenting with external data, and like, how do you decide what type of data, and do you introduce any other overrepresentation of anybody, and what? Like, I know very little about bond data, so I'm just interested.
Basically, we contacted every trading venue there is, and some of them gave us the data, some not. So they are obliged to upload this data, but only for 1 day of history. That's a regulation in MiFID. So if Bloomberg, for instance, if there's a bond trade or an Italian bond trade on Bloomberg, Bloomberg is obliged to upload that data to the cloud and say the timestamp, the ISIN, and the price, and sometimes also the volume, but it's only available for 1 day. There's no history. And to us, some of the trading venues, they gave us the data for the past history. And yeah, we tried to get all, but yeah, Bloomberg, for instance, we were unsuccessful there, so they didn't give us the data. And yeah, our goal in the end is to have a representative sample, but yeah, we're only certain that for Germany, we're pretty certain we have a representative sample. For the other countries, not so much. So for Spanish bonds, for instance, we're pretty sure that there's lots of trades we don't observe. But actually, it's not a big problem because we do a diff and diff approach here. And so all these compositional stuff, that cancels out, actually. So that's not a big worry to us.
Thank you.
Okay, so on to the first kind of outage. So what happens when the futures market in Europe goes down? So this is Eurex. And we focus on 2 outages here, the most recent ones, because we have the best data for that sample period. And these occurred on 14th of April and 1st of July 2020, and lasted about 3 or 4.5 hours. And regarding the reason, the cause, Deutsche Börse just said they had the same origin and were due to faulty third-party software. And since then, hasn't been any other outage, so apparently they fixed the problem. But the key thing is that it's totally exogenous. It's not related to like higher volatility or anything. It was just a technical glitch that caused Eurex to go down. And what we're interested in is the effect on the cash market. Okay, so what you see here is that when Eurex goes down, the liquidity evaporates. So here we have the two outages are in the column, and each row refers to a different country. And we are plotting the order book depth on MTS, which is the dealer-to-dealer platform in Europe, basically the only noteworthy one. And we look at the total quoted volume in billions of euro across the entire order book at 5-minute snapshots. And you see in the blue lines, that's what the usual case basically. In red, you see the outage day. And for Germany, for instance, basically the entire order book evaporates. It's not a single quote in the order book. For Italy, it looks slightly better, but even there, it's dramatic, the effect. So decreases by more than half. And France and Spain also. And yeah, this is the dealer-to-dealer venue because this is the only source for executable quotes there is. What we also look at is indicative quotes. So these we got from Bloomberg and Refinitiv, which are dealer-to-customer platforms, and from TPI-Cap, another interdealer broker. And these quotes usually should reflect market prices, should be pretty close because when a dealer contacts his client contacts his dealer, he usually looks at these at the Bloomberg screen or the Refinitiv icon screen and asks for that price that's posted there. And then they negotiate the final price. But usually these indicative quotes should be pretty informative. And what we see is that they become stale. So these are not updated anymore. As soon as Eurex goes down, they are just stale. It's just, if they are visible at all, they just copy paste of the last price. So again, we would interpret this as a breakdown of so nobody's willing to quote even indicative quotes without the futures market active. And then most importantly, this is the pricing. So these are yield curves, and each circle is an actual yield. An actual transaction price we observe in the secondary market, and we convert the transaction price to a yield, and then just do a scatter plot of maturity versus yield and fit a yield curve via Swenson. And what you see in the top left corner, for instance, that's a usual day, 7th of April. You see that the transaction yields are closely in line with the yield curve. So you don't see much of the yield curve with the black line because all the circles are on top of it. So that's a properly functioning market. And then 14th of April, during the outage, you see this huge dispersion in yields. So they're all over the place. I think the sound is good for everybody? No. Okay, so
yeah, I think the sound is good for most of us, but since you paused, I think there is a question from Jim Angel in the chat, and I don't know if he wants to voice it, or I can just read it quickly. I wonder whether that Jim, would you like to? I'll ask to unmute.
Yeah, no, I read.
It's really just a dumb question. I noticed that there were 2 outages in 2020 from defective external software. And I was just wondering whether it was the same external software or whether it was 2 different software vendors that had problems.
So nobody knows basically because Deutsche Börse doesn't say. That's a short answer.
Thanks.
The only thing I know is that these 2 incidents were not without precedence. So there's been at least a dozen outages before. So I'm not sure. I guess that speaks to different software glitches as a cause.
You should probably also mention. Sorry, since since we interrupted you already, that Mark originally said he wouldn't mind being interrupted with questions throughout. So if you have questions, also please feel free to raise hands, and I'll ask you to unmute. Thank you, Mark. Go ahead. Sorry.
Yeah, thanks. Okay, so punchline of this figure is that usually the yields are closely in line with the yield curve, with fair prices, but not when Eurex is off. So then the prices are all over the place, and you can compute this noise measure, this root mean squared error. So you square the deviation of every circle here from the fitted line, square it, and then take the root mean, and you see that this noise measure increases fivefold roughly. So it's pretty big, the effect. You can also see this here. So here we do the exact same thing as before. We fit yield curves and compute this root mean squared error. And now we compare the outage window with the exact same time window on the previous days. And you see that these outages, the 14th of April and 1st of July, were gigantic events. So they were even bigger than the turmoil in 19 March, the COVID crisis. Then you can recall the day before, 18th of March, the ECB intervened in markets with the pandemic emergency purchase program. And the two outages, they only lasted a couple of hours, but yeah, within these hours, they were bigger and had a more impactful, had bigger impact than the COVID crisis. And as a side note, here in gray, you see the daily measure published by Hu and al. And you see that usually the German yield curve noise is pretty in line with the US Treasuries, which makes sense because both are the safe asset benchmark. And yeah, our more wobbly series is just due to the fact that we use intraday transaction prices, whereas the US measure is end of day prices. So you get a clean cross section at the same exact point in time, which we don't have. Okay, so visually we can see that this spike in mispricing is pretty big. And now we just want to make sure that it's really statistically significant. So what we do here is on the left-hand side, again, we take the deviation of every transaction yield from the yield curve and then regress it on a dummy and on a bunch of fixed effects. So that's the absolute pricing errors on the left-hand side. And then on the right-hand side, you have this outage dummy, which equals 1 during the outage and a 0 during the same window in the previous and subsequent week. So we have about 3,300, 3,400 transactions. And you see that the average pricing error roughly doubles. So usually, on average, if you transact a German Bund in the secondary market, you're usually off by 1 basis point from the fair yield curve. And during the outage, it more than doubles. And now we introduce in columns 2 to 5, we sequentially add fixed effects to see if this is driven by compositional effects. So in the second column, we add ISIN level, so bond level fixed effects, and we see that results don't change. So it's this increase in noise is not driven by different bonds being traded. So it could be that trading just moves to different kinds of bonds, which are illiquid anyway, and are ridiculously priced, but that's not the case. So next in column 3, we introduce the venue level fixed effects. And there you see some decrease. So some of this increase in noise is driven by different venues being used. So trading moves to systemically less efficient or trading venues with systemically higher pricing errors. And these will turn out to be electronic platforms and exchanges. And then in column 4, which has an even bigger impact, is if you control for the buyer and seller ID. So there, the effect of the outage decreases considerably. So that means some of this effect is driven by a different investor pool. So different people being active during the outage. And will turn out that the more sophisticated people, they just retracted and waited out the outage. And the less sophisticated investors and with a higher urgency to trade, they kept trading. And that's why you see a decrease here if you control for the identity of the buyer and seller. but it's still way significant. So it's still close to a doubling of the pricing errors. And then lastly, the volumes, if you introduce volume deciles, that doesn't have any effect. So it's not due to smaller trades, for instance, being more mispriced and then having a higher share of trading during the outage. That's not the case. So what's key is the venue and the investor. And these things we will investigate further. So the most simple mechanism to explain our results, I'll go into detail later, but this is basically the key mechanism we think we've discovered. So causes the cash market, the futures market causes a cash market breakdown because dealers stop intermediating, because they usually use bond futures as a hedging instrument, and they don't take on inventory risk anymore if the futures market is off. That's why they are the sophisticated, informed traders. They leave the market, don't trade with clients, and if so, only at a big bargain. And on the other hand, you have clients, and especially those that want to trade now and not, and they trade with other clients because the dealers left, and they trade at dislocated prices. So usually these clients benefit from the bond futures as a pricing signal. Either they look directly on Eurex, or they just, because Eurex is a public good basically. And when this pricing signal is gone, they trade at ridiculous prices with each other. And that's not the whole story, but that's the key thing. So this dealers versus client and the hedging versus pricing or speculation channel. Just reading the chat now for a second. How did the outage in the futures market affect trading volumes in the futures market? The went down to zero, right? Because you couldn't trade futures anymore for 3 or 4 hours. And there's only one futures market in Europe. So Eurex is the only place you can trade bond futures. When with Eurex gone, there's no alternative. Okay, the cash market trading volume makes more sense. The question, they went down also. So you can see this already from the scatter plots. There's way more dots here or circles here in the non-outage periods than during the outage periods. So roughly speaking, volumes went down by half or so. And equally for Germany, France, Italy, Spain. Okay, so why do we make a big fuss out of this dealer versus client and hedging versus pricing story? Because that explains a lot of our results already. Actually, the bulk of our results. So it explains explains who commits the pricing errors. So it's clients more than dealers who commit pricing errors, because they are the less sophisticated investors. And also within clients, it's again the less sophisticated clients that commit the pricing errors. So it's more households than, say, investment funds or banks. And within the banks, it's the non-dealer banks, the less sophisticated banks that commit the pricing errors. And the results also explain this dealer-client differentiation, also explains where the pricing errors occur, namely on regular exchanges and on electronic platforms mainly, because these are accessible also to households, for instance, and other clients. And you do not see a big spike in pricing errors on dealer platforms, for instance, or via interdealer brokers, because that's where the dealers are active, and the sophisticated dealers, they know the fair price of a cash bond even without the futures market active. It also explains which bonds and trades become mispriced. It's especially the small trades whose pricing errors spike, and especially in short-term non-CDD bonds. So this is a segment where dealers are not so active. And the opposite is true for the trading volumes and liquidity, because those drop, the trading volumes drop more in long-term bonds, but the pricing errors increase less in long-term bonds. Again, that's driven by these dealers being more active in this segment. So dealers retracting from the market. That's why there's less trading in long-term bonds, which they usually do. But if they do trade in long-term bonds, they trade at fair prices. Okay, now I will go through some of these results. Again, a question in the chat. Economic significance. Yeah. So if you do the mispricing, volume weighted, then yeah, it's less of a significance. But I think our claim is that people trade for a reason, right? So there must be an economic cost of not being able to trade. When usually the trading volume is 10 billion, say, a day, and then Eurex goes off, the trading volume reduces by half, then must be an economic cost because yeah, usually there's gains from trade. But you're right that the volume weighted mispricing shows less of an effect. The price pressure stuff I'll come to. Yeah, some of that we can address. Okay, so on to the micro level evidence. So here we look at trading volumes and mispricing across segments. And as I said, you see barely any reduction in trading volumes on the client-to-client segment, but the huge, gigantic increase in mispricing. So many clients are actually unaware probably of the outage, just keep on trading like households, and they get ridiculous prices because no one's on the other side. Either it's a dealer on the other side, but they take a big price discount, or it's other uninformed clients. Then on the dealer-to-client segment, it's an intermediate case. It's in between. And then the dealer-to-dealer, basically, you do not see an increase in mispricing. So the entire dealer-to-dealer segment, the volumes go down rapidly or dramatically, but you do not see an increase in mispricing. So when dealers trade with each other, they don't need the futures market as a reference point. They know what the fair price is. And you could also interpret this as well-informed either or patient. They just sit out the outage. And clients, especially those with an urge to trade or those that are unaware of the outage, they keep on trading.
It's interesting that you have like a decline in the dealer trading, but there is no decline or increase in the customer-to-customer trades, right? So there's no substitution for I trade with dealers normally, and now there are no dealers available, and I'm gonna go trade with customers. Is it like different types of customers that trade customer to customer, or?
Exactly. So if you would break the clients down, you see that households do not decrease their trading volumes at all. The retail people, they just keep on trading like usual because they don't know that that Eurex is off. And on the other extreme, you have like the official sector, central banks and foreign central banks, debt management offices and stuff like that. They reduce their presence rapidly. So yeah, that's driven by this cross-section of clients. But that's just the big picture overview now. So from investor segments, next we look again at volumes and mispricing, but now across trading venues. And there again, like I said, the most extreme case is the regular exchange here, where you do not see any decrease in trading volumes, but a gigantic increase in mispricing. And that again speaks to these retail investors that are active on a regular exchange, like the Frankfurt Stock Exchange here next door. That's where the households or retail investors can trade, and they just don't know that Eurex is off. They submit their market orders, and there's no one on the other side. And if there's anyone, then they demand a huge discount or premium. Depends on the side. What you also see is that the outages is similar to an urgency shock. So usually investors use low-cost, low-immediacy venues like the OTC market first, and then last they use the high-cost, high-immediacy venues like exchanges. And during the outage, it's exactly the opposite. So if you have to trade and nobody picks up the phone in the OTC market, your dealer doesn't pick up, then you have to go to the electronic platform or to the regular exchange, and then you get bad prices. So that's similar to an urgency shock, with the caveat that the aggregate trading volume goes down, right? With the pure urgency shock, you would expect everybody is willing to trade increase and trading volumes increasing on aggregate, but we observed the opposite. So the sophisticated, well-informed people, they just sit it out, and the remaining investors have a higher urgency to trade. There's a more toxic investor pool, let's say, and they cause these mispricings. Dealers making money, yes, that's what I'm about to show. So now we go from we've seen client to client, the investor segments and the trading venues, and now we go down to the investor types. So one level of granularity lower. And there again, you see, we first look again at the absolute mispricing, and you see that everybody's basically causing these mispricings. But most importantly, it's households. So trades by households, they are off by 4 basis points, more than usual during the outage. But it's also bank dealers, non-dealers, investment funds, everybody's trading at crazy prices. Now, onto the second measure is a markup measure. So how beneficial was the yield you got? So this is the yield you got versus the fair yield. And if it's positive, it's good for you, right? For the buyer. You got the Bund at a 10 basis point yield where the fair yield was 1 basis point, let's say. And it's the opposite for sales. So we reverse the sign for sales. And you see that bank dealers, yes, they charge a markup. And households, for instance, they get ridiculous prices throughout. What this markup measure does not measure, not capture actually, is the total cost of trading. So the total profit. So when you weight this markup measure by the volume and the duration of each bond, then you get the total euro amount you made off of someone, basically. So if you get a 1 basis point too high yield, it's twice as important if you have twice the volume, or if the bond has twice a long duration. And if you do this profit calculation, then again, you see that bank dealers make more profit during the outage. So they demand a discount or premium, depends on the side, during the outage. So they only trade at very beneficial prices for them. And at the other extreme, you see households again. And this divergence between column 2 and column 3, that's again driven by this volume and maturity. So on average, a bank dealer demands a slight markup, only 17 basis points, but especially in long-term bonds and especially in big ticket trades. And that's why the profit measure shows a significant large increase. And it's the opposite, for instance, for investment funds. They also trade at beneficial prices on average, but if you weight by the volume and the duration, they actually lose money. And for households, yeah, they trade more in short-term bonds and in smaller ticket sizes. That's why the profit effect is not that big. Let me read the chat again. So dealers making money, yeah. European rules and best execution. Good question. We would have to ask ESMA, I guess. They are in charge. I wouldn't know. I know that on MTS, I think they have an exemption in case of outages. Usually they are required to quote for X hours per day, but if there's an outage, I think that's an exemption case. Unusual surge in trading volumes immediately after on the futures market, right? On the no, actually on the futures market we see
on the cash market.
Yeah,
actually, I'm going back to my earlier question. If trading in the cash market was half the usual, was there evidence for catch-up volumes after that?
Yeah, in
this
the cash
would support
market,
your story that there was hindered trading and cost to execution, so people actually were forced to wait.
Yeah, I think I have that slide in the appendix, but yeah, you see a catch-up, especially in the first outage, but yeah, in both cases, I think. So at the end of the day, it's almost back to normal, the total daily trading volume. That's why you wouldn't even notice this outage in daily data. So you really need this intraday transaction data to spot the outage.
Yeah, I thought this could be interesting to add to support the economic, because this would basically point to longer lasting outages causing more severe damage then, because maybe during a short outage, normally traders could delay their execution, but only up to an extent. Eventually, they may be forced to trade.
Yeah, agree.
Thank you.
Okay, so the last puzzle or stuff we still have to do is this hedging versus pricing function dichotomy. So we claim that bond futures serve different main functions for different investors. So dealers use it as a hedging instrument, and that's already pretty well established, I think. This paper I found for the UK and a recent one by Michael Fleming for the US, where they show that dealers do use bond futures to hedge, and particularly inventory risk that arises from their cash market intermediation. So not necessarily when they take on bonds at auction, for instance, but when they take on a bond on the secondary market from a client that may be informed, they hedge those trades on the futures market. But yeah, we can and should confirm this also for the euro area. So we have this transaction level data also for the futures market, and we will double check that this hedging story also applies in the euro area, but we are pretty confident. So the people in the financial stability department I talked to, they already ran the regressions and they found exactly that. And then the other thing is that dealers use it more for hedging than clients, right? And then in some sense, it's already obvious because almost all dealers we have in our sample use Eurex. And very few of the non-dealers use futures. So of the 31 dealers we identified in this sample, only for these, we were zooming in again on these 6 days in 2020, we have 31 different dealers being active on the cash market, and all but 2 are also active on the futures market. So we just checked whether the LEI also appears in this EMIR transaction level data set. And they do usually use bond futures. And for the clients, for the non-dealers, we have 510 different entities, and only less than 10% of those use Eurex. So these are hedge funds and investment funds that are also active on the cash and the futures. But usually, like insurance companies, non-financial corporations, households especially, they are only active on the cash market. They don't have access on Eurex. And that's already prima facie evidence. We think that there's this distinction that dealers use futures more as a hedging instrument than clients. Okay, so this is a summary table comparing our Eurex outages to other shocks we already studied in the literature. So we think this Eurex outage is pretty similar to a dealer capacity shock. So this very recent paper by Duffy et al., they show that when dealers are constrained, can't take on inventory anymore, then the cash market suffers. And that's exactly like our paper provides natural experiment evidence in that regard. So there's a natural experiment shock taking off this hedging instrument, and you see exactly the same as they show in the COVID crisis. So if you shock a dealer capacity, then you get bad results on the cash market. Also similar to a liquidity supply shock. That one you can also see on this co-movement between noise and inventory. So noise goes up, the dispersion in yields spikes, and what I haven't shown you, but it's in the next version of our papers, that dealers take on less inventory than usual. I mean, it's already obvious from their trading volumes. So dealers just stop trading, they take on less inventory, only at huge spreads, and that's akin to a liquidity supply shock. Then thirdly, it's also similar to an information asymmetry shock. So we see the largest spike on the cash market mispricing for the least sophisticated investors. So there's this, usually you can think of the Eurex bond futures as leveling the playing field. So everybody has the same information. Everybody can look at on Eurex and provides this reference benchmark price. But when that's gone, then only the sophisticated investors trade at fair prices, and everyone else gets bad prices. And what we have to do still is to study the cross-section of clients and dealers more. So I've shown you that households, for instance, have higher mispricing than investment funds, but we could also look at within investment funds, is it the more or less connected, the investment funds with lower trading volumes that show higher mispricing. And we would expect that, yeah, the sophisticated ones, they show less pricing errors. Then for the dealers, we could also look at which dealers cause the mispricing actually. Is it the smaller or bigger ones, or the more central ones? And you could also look at dealer-client pairs. So there was a suggestion by Gabor Pinter, and we still have to check it out, whether the dealers only ripped off clients that are not usually their super trusted customers. That could be a story. Then I already hinted at this urgency shock. So we do see that the market share of this high cost, high immediacy venues goes up, and low cost, low immediacy venues like OTC goes down. And that's exactly in line with this urgency shock. But in contrast to that, we see that the aggregate trading volumes actually go down. They do not increase. So we see, yeah, it's basically the remaining investors have a higher urgency to trade. And lastly, was the fire sale story. We do see that investment funds sell assets at dislocated prices, but they actually make a profit out of that. So they charge a markup, or they get better prices than they should. So that's again at odds with the fire sale, and they do not significantly lose money from those trades. So the profitability is barely affected. Okay. So a couple of alternative explanations we thought of and we wanted to rule out. The most obvious one is that maybe the outage was just causing a market panic. So everybody is going crazy and doing crazy things. And in that case, you would expect, in the simplest version, at least in a market panic, you would expect that people sell off risky securities, right? They bid down the stock prices and stuff, and you don't see anything of that. So these are percentage points, the top figure, and you like the S&P 500 future went down by less than half of a percentage point, so that's not a big. And then the second outage even increased, so there's no big sell-off or anything. And in the second figure, another implication of this market panic, dash for cash, flight to liquidity or safety story would be that the people run into bonds, right? So the whole yield curve should have moved, should have gone down, right? Should have depressed the bond yields. And that's also not what we find. So it's the dispersion around the curve that increases, but the curve itself barely moves. The two other ones, this is a selling pressure story. We also didn't find any evidence of that. And lastly, this malfunctioning trading algos, someone suggested that. But again, our mispricing is way too. So the story here in the third one is that maybe some investment funds that are active on the futures and cash market simultaneously, like their algos go crazy because the input price from the futures goes away. And then they trade at ridiculous prices on the cash market. But the mispricing we find is way too widespread. And it's more driven by investors that are not even active on the futures market. So that doesn't make much sense. There's another question in the chat. Cash and futures cross-margining? Nope. I don't think so. So in the futures market, that's one of the big advantages, that you can cross-margin. If you trade Euro stocks futures and Bund futures and Italian bond futures, these are all netted. But on the cash market, I wouldn't know any like I think Eurex at some point had a cash trading venue, but like if at all, there was a tiny market share. So I wouldn't know any way to cross margin between the cash and futures market. Okay, so if there's no further questions, I would go on to the second kind of outage. So now we look at the other way. So we look at cash venue outages and how they affect the broader cash market and the futures market. And we got 5 different outages affecting 4 different venues. So MTS, this interdealer platform, went down twice. Bloomberg once went down. The Frankfurt Stock Exchange here went down also. And BrokerTech also in 2019, I think, went down. And we use the exact same methodology. We do simple dummy regression. And we first check is whether this cash venue outage affected the broader cash market. Maybe it doesn't. Maybe just people go to other cash venues when one venue goes down. And secondly, we look at the effect on the futures market. So here again, I won't go through all coefficients here, but each column here refers to a different outage, and each row refers to a different independent variable. So in the very first column and row, we look at the effect of the MTS outage, the first one in 2010, on the aggregate cash volume. And again, we see a drop in the aggregate trading volume and also in the number of trades on the cash market. And we do see that for almost all cash venue outages. So if you focus on the very last column here, the pooled results, yes, we do see an effect. If one venue goes down, then the aggregate cash volume also goes down, which already says something about the substitution. So there's often a claim by market participants that in case of an outage, trading seamlessly moves to alternative venues, but that's not what we find. So if one single venue goes down, then the aggregate cash volume also goes down. And that also means that we could find something on the futures market, but we barely do. So the second panel here, this is the same setup. We look on the futures market, the trading volume on the futures market during the outage and during the same window in the previous and subsequent week. And again, just focusing on the very last column here on the pooled results, we do see a slight decrease. So there's slightly less trading volume on the futures market in case of a cash market outage, but the results are just tiny in comparison. So if you recall, the trading volume in the other direction, trading volumes go down by half and the liquidity evaporates entirely almost. And here you see a slight decrease in trading volumes, and also here a slight decrease in this market functionality measures. So the Amiot and roll illiquidity measures, they do increase even significantly, yes, but only by less than a tenth of a standard deviation. So this is orders of magnitude less than in the other direction. And I think it's most intuitive to look at specific examples. So here is the most recent outage on MTS in 2019. So this is an unconfirmed outage. We contacted MTS and they declined. They say it's there wasn't an outage, but we do see it in the data. It looks exactly like the confirmed outage in 2010. So we are pretty certain that there was an outage here on MTS. And we don't see anything on Eurex. Does the FVB outage include Xetra? No, because on Xetra you can't trade bonds. If you want to trade bonds, you can only trade them on this Frankfurt Stock Exchange, the FVB. And Xetra is only for equities. MTS outage in trading or data dissemination. So in 2010, that's a confirmed outage. MTS admitted there was an outage. Here on the first one, there was a newspaper report and also a public MTS apology, basically. The second one, we are not 100% certain, but in the data, it looks exactly the same. And we can't think of a reason why the data dissemination should be affected. So we asked them to provide the data for that day, and they said that's all they have. So I'm pretty certain that it was a proper outage. And yeah, you don't see if MTS goes down, so this main dealer-to-dealer platform, you don't see anything on Eurex. And recall when Eurex went down, MTS was dead, right? There was no liquidity. The order book was zero basically on MTS when Eurex goes down. In the other direction, this is again the order book volume of the bond futures and the French and Italian and Spanish bond futures, and you don't see any effect. Nobody's basically on Eurex, nobody cares whether MTS is online or not. Another type of outage was the broker tech one in 2019. And in the left panel again, broker tech, as you may know, is the dominant trading platform, electronic trading platform for US treasuries. Has less of a market share in Europe. And again, you see nothing. So the German bond future trading, the order book depth is unaffected by the outage on broker tech. And that may not be too surprising because broker tech has a minor market share. But even in the US, you don't see anything. If at all, you see a slight spike here in the order book depth, an upward, like better liquidity on the futures market with broker tech being off. So again, that says is in line with our claim that nobody in Chicago cares whether broker tech is online, and nobody on Eurex cares whether the cash venues are online. And the story we think is relevant here is again that in contrast to the first one, it's only the hedging channel that's being active here. So if a cash market venue goes down, there's less trading on the cash market, obviously. Like we've shown, the aggregate volume goes down, and then there's less hedging demand. So people need less bond futures for hedging. So that reduces the trading activity on the futures market. But in contrast to the story before, it's nobody cares nobody looks on the cash market at a on-the-run price for a bond, for instance, before trading the futures. So there's no price information, no pricing signal from the cash to the futures market, and that's why the liquidity is barely affected on the futures market. So that's yeah. Basically, this liquidity provision price discovery is a one-way street. That's our claim, from the futures to the cash market. It's way bigger and more dramatic than these vector error correction models usually suggest. So they find that a higher information share on the futures, okay, and a slide like the futures incorporates information a few seconds or minutes earlier than the cash market, but we think it's much more than that. So the cash market barely functions without the futures market. So most of the pricing discovery is on the futures market. All right, I'll stop a second for potential questions. Otherwise, I would go on to the last kind of outage, which are the spillovers. So here we look at outages on the futures market in Europe, like the Eurex outages we just studied, and look at the effect on the US futures market, so on CME in Chicago, and in the other way. So there was an outage in February 2019 on CME, and 6 outages in 26, 27 on the predecessor of Chicago Board of Trade, where the Treasury futures were traded. So this is again the Eurex outage, and now we look at the order book depth of 10-year Treasury futures on CME in Chicago. And again, you don't see much. Well, maybe here in the first outage is a tiny temporary decrease in liquidity, but otherwise nobody in Chicago cares about bond futures on Eurex. And I think maybe not too surprising, because we know that the pricing spillovers are way stronger from the US to Europe than the other way. But it's also the case in the other way. So if CME goes down, Chicago stops trading Treasury futures, then again, nobody cares on Eurex. So the aggregate trading volume in futures barely budges. So this is the aggregate trading volume in thousands of contracts in all bond futures on Eurex, normalized to 0 here to make it comparable. And you don't see much. And again, we can zoom in on the Bund future, look directly at the liquidity, at the order book depth. And again, you don't see any effect here. And now, okay, the downside of this outage is that it occurred very early in the morning. I think Friday, like 3 p.m. in the US. It was 2 a.m. in the night, next day in Europe. So you might say, okay, this is due to the timing. But again, if we look at the previous outages, there were 6 of them in Chicago. Again, you don't see anything on the European futures market. So here we don't have the order book data for the old sample. So we look at the trading volumes. And again, you don't see much. So you don't see a decrease in trading volumes, which I would have expected when Eurex goes down. So here it's a bit of a puzzle to us. So on the one hand, you might say that an outage should increase liquidity, increase trading volume if it reduces latency arbitrage. So that's the paper by Andre on these weather events between Chicago and New York, when the high frequency people that usually exploit and rip off people they have early access to the Chicago prices, and then they front run people in New York. And with the bad weather, this advantage goes down, and that's why liquidity increases in New York. That could have been active here, right? So when people use the US Treasury futures to front run people on Eurex, then the liquidity should have increased on the European futures market, but that's not what we observe. And on the other hand, we do see there's the alternative story, like we find for the cash futures spillovers, that if the Treasury futures are a relevant pricing signal or a hedging instrument maybe for European bond futures, then outage on one exchange should decrease liquidity on the other. But yeah, again, we find a null effect. So either it's that none of these channels is active, or they exactly cancel out, which is also would be quite a coincidence. So I'm still puzzled by this. So because we know that even in the millisecond frequency, we know that if the Treasury future moves, then the Bund future moves in the exact same direction, 1-to-1 almost. So there must be someone active on both markets at the same time, using the same info at the same time. But apparently, the outages do not spill over across the Atlantic. Okay, then on to the conclusion. So 3 main points. We show that bond futures are key for market functioning on the cash market. So these well-informed dealers, they usually use bonds as a hedging instrument, and with the hedging instrument gone, they stop intermediating, they stop taking on inventory risk. And that forces clients who do not know the fair price because the futures is gone, that forces them to trade with other clients at crazy prices. And then looking the other way, we find a strong asymmetry. So cash venue outages barely affect the futures market. We do see some decrease in trading activity that could be due to less hedging demand. If you don't trade, if you trade less on the cash market, you do need less bond futures for hedging. But otherwise, this liquidity market functioning is barely affected. So that suggests that price discovery and liquidity provision is more of a one-way street from the futures to the cash than previously thought. And then lastly, there's no outage spillovers between the US and Europe on the futures market, which is in stark contrast to strong and quick price spillovers. So if you have any clue or any idea why that could be the case, then we're all more than welcome. Very briefly, contribution to the literature. So our results are incompatible with this cross-market arbitrage story, where the story usually goes that someone, high-frequency people, whoever, is active on one exchange, conditional on the other. So they exploit mispricings and are only doing these arbitrage trades when both futures are both markets are active. And that's not what we find. We find a one-way street from the futures to the cash. So this is way more in line with this cross-asset learning models. And there the story goes that some asset price is particularly informative, and that's used as a reference, as a benchmark price to price other stuff. And in our case, it's the bond future, which is super liquid, super informative. And that's the benchmark price, a reference point to trade all cash bonds. Secondly, market structure trade-offs. So we show that this decentralized cash market that usually works fine, but only because it free rides on the centralized futures market. So the bond market only works fine usually because we have this positive externality of the futures market. And if you would centralize the cash market, then you get plenty of benefits, like on the futures market. You get more liquidity, probably more price discovery, but you would also increase systemic risk. So the futures market outage is basically a systemic risk because there's only one place you can trade those. Lastly, limits to arbitrage, dealer capacity. So basically, we think of our results as experimental evidence supporting this channel. So because of the decentralized market structure, intermediaries are super important on the cash market. And that's exactly in line with the recent US Treasury evidence by Duffy et al. So this is an exogenous dealer capacity shock, basically. And dealers can't intermediate anymore. And that's why the market, they can't fulfill their intermediary role anymore. That's why the cash market breaks down. All right. I got lots of appendix slides, but let me stop here and thank you.
Thank you very much all for coming. So before we go to any questions that you might have, and Mark has kindly agreed to stay for a few questions, I just wanted to say we hope to see you all in 2 weeks. So on November 26th, we'll have Amber Anand presenting. Thank you all. And now we'll go to questions. I'm going to try to unmute Pankaj. Oh, he's unmuted already. Pankaj, go ahead.
Yeah, thank you. Great presentation, I think. Very nice paper, and good to know that the interconnections only work in some situations. Like I think Andre's paper, I also published a paper recently. We find actually that there is a strong connection between the ETFs and the futures. And you're saying it's one-way street. I think that may be a very strong conclusion you're drawing. Whenever the order imbalance is high, it also works from the cash to the futures. Maybe during the period of outage, the order imbalance was not very high, or it was not expected to be high. So you may want to...
Your evidence is on equity markets, I guess, right? Do you think that
yeah, ours was a little bit more. But I'm thinking even for the bonds, if there is an order imbalance, right, in the cash market, it will definitely affect the price discovery in the other direction. So during outage, maybe there was none, right? Or before the outage, there was no order imbalance happening in the bond market, which is why you're saying that, oh, okay, there's a one-way street. But I think that's a stronger conclusion than what we may want to draw from just the outages.
Okay, thanks. I found in the chat box other trading venues available for futures. No, so Eurex has a monopoly basically. We got, I think, interest rate futures. They went from Eurex to London to LIFE or ICE named nowadays. But government bond futures, European or Euro area government bond futures are only traded on Eurex. So they got a monopoly. Options on futures. Again, options on futures all only traded on Eurex. So they couldn't be traded anymore. That might be one caveat basically. So maybe it's not the futures that matters, but the options on those futures that matters. That I can't rule out.
Yeah, I think I was saying that at least from the CME side, if the outage doesn't spill over, it could be that those who are trading on the futures are moving on to options on futures that's still traded on CBOT and stuff. Just a small maybe explanation that you could maybe hang your hat on, but just a suggestion.
Thanks, yeah.
Any other questions or comments? Well, thank you, Mark, very much. This was very interesting. Thank you all for coming. And again,
Thanks for
we
having me.
hope to see you in 2 weeks.
Thanks.